Welcome to Breaking Banks.
Today, Brent and I talked to Nick Elders, Fintech provocateur, president and co-founder of Spark from Ignify Technologies. Spark is a social mission-driven company whose cloud-based origination platform helped originate $9 billion in aggregate loan activity, over 50,000 loans in the first 2.5 months of PPP. This is not another story of small business lending platforms, however. It's about the power of purpose and the need for intentionality. Networks become powerful amplifiers of either good or propagating old stereotypes and systemic bias. Let's hear what Nick has to say.
Nick, thanks for joining us today. And, where I'd love to start is, we're in an era of massive amplification, right? If COVID and the last 4 years have taught us anything, it's the power of within media for things to be amplified. But there's another effect within the banking and specifically, the lending segment around amplification. And you have some really interesting views around that I'd love to begin to explore there.
Yeah, thanks for having me. When we think about, most people think about when they're building a technology, they often think about their customers as just that customers. We really view the folks that join our platform as becoming part of a community, and we also think about them as becoming nodes on a network. And that really becomes powerful when you start to think about grabbing banks in North Carolina, grabbing banks in Texas, grabbing banks in California, grabbing banks in the Midwest. At the same time, there's a tangential part of our business where we started, which is grabbing CDFIs in those same markets. And so when we start to think about network effect and amplification, that's where it gets really exciting. Is once you start to put a bank on a loan origination technology and a CDFI on that same loan origination technology, that historically hasn't ever existed in the market. There hasn't been a provider who's come along to say, hey, let's do both, because historically it's been very challenging even to just get loan origination technology established in the bank sector. And now we're getting it in both. So therefore, we're well positioned now to connect these two industries, which have historically operated primarily on handshake basis. Well, now we can connect them systemically. And that's where things start to get really exciting.
Well, explain what Spark does, because you've hinted at now, it's much more than a loan origination platform or a piece of software. This network effect and your approach to the market is, very different.
Yeah, so we're sort of disguised as a loan origination technology today. You have to have a product that's useful, and so today that's kind of how we're coming into the market, and that's kind of the first leg of our business is all about scale. So scale for us is adding more and more nodes to our network. So today our product Spark handles everything from an inquiry, so a customer that might be sort of a small business that might be on a bank or CDFI's website, providing a little bit of information to start the process. So that's typically where you see the fintech companies, getting that inquiry form initially started. From there, we move to a secure portal and application experience. So what that means essentially is historically, it's been very difficult for banks to engage with small business owners directly. They've been reluctant to do that. We're providing a secure means in which a business owner can transact directly with the bank, where they're providing their data, their documents, any sort of specialized information that's needed for that bank to make a decision. From there, we move into the actual underwriting and analysis that the bank has to perform. Historically, that's been handled by macros and Excel workbooks and all sorts of other things. We're doing that systemically in a loan origination solution, so we can speed up decision-making. Inside of there are links to credit scoring algorithms and other things that can help people make decisions faster. The good examples are like PayNet, LexisNexis, et cetera. From there, then we move into where banks live today, which is forms creation. So there's still a lot of forms being produced in the lending world, primarily things like notes, mortgages, deeds of trust, et cetera. So all of that is contained within the solution. And then we also go into a little bit into post-closing, where loans are actually dispersing. So in the cases of small credits, typically that's one disbursement, but in the case of larger, more secured credits where we operate, that's typically done over a construction period and a multi-draw period. So we handle all of that. And then we wrap that all around it with a huge open API. I think the days of closed off systems are over. We're not so naive as to think that we're the only system in the bank. We have to talk to a lot of other systems. And so we kind of started with that as the as the thesis for how we would move this technology forward.
I'm interested, Nick, in the fact that, I've run SMEs for the last 30 years. And, whenever you get into a lending decision, you're always asked for 3 years of your financial statements when most banks already have all of that information, right? Because they've got your bank statements. We've just started to see tie-ups between, for example, Starling and Zero Accounting in the UK and others. It always has made sense to me that, if you have the cash flow of the business, you should be able to predict their credit needs in advance rather than this antiquated system we have today of asking for financial reports and sort of reviewing those. So, where does sort of predictive fit into these models now? You talked about credit score and LexisNexis and so forth, but, we're already starting to see the shift in buy now, pay later in the consumer business. The real trick here is predictive cash flow for businesses and, factoring and stuff like that. So, where are the models emerging in respect to those types of opportunities for business?
Absolutely correct. So we're working right now with 2 providers. We're evaluating both simultaneously. One is Codat. So they're over in the UK. They're kind of moving into the US. Another one is called Forward AI. And so both of those solutions take into effect the business information, and they start to push out and do all of the analysis so instantaneously. So if you think about the potential for that type of a solution to come into play, think about it more from think of the bank as like the hospital. The patient walks into the hospital when they have a broken arm, rather than kind of, I think where you're describing, Brett, where the world is going, which is more preventative healthcare, where we think about that in terms of business owners the same way. So interpreting the data, making predictive decisions, and then helping banks push solutions out versus wait for them to come in. That's exactly where we're going. And so that's where these solutions like Forward AI and Codat, in combination with, Plaid has done an amazing job of actually helping the banks understand the data that they have. So again, using these solutions, like the other strength that we bring to the table is helping banks turn the fintech ecosystem in their favor versus sort of fear being replaced by it. That's another big thing that we really want to help everybody understand is like you answered the call during this pandemic, but let's not let that opportunity slip by and go by. Let's leverage it and kind of push forward into this next generation. Now, there's a place where banks aren't quite ready yet to make those leaps, and that's where you have to help them by building trust, by helping them do the things they do today. So we're doing that. At the same time, that'll position us well to lead them to this next thing that's coming.
I love you need to crawl, walk, run in terms of helping the banks to evolve. Where do you think ultimately, like let's get into the walk and maybe even the run. What needs to change as we think about the lending ecosystem and how we engage both banks and fintechs and those we're lending to?
Yeah. So I think one of the biggest barriers that we're up against right now is just straight up inertia. So I think there's people that don't understand yet that they have a problem. And so sometimes you're trying to convince them to understand that they have a problem and create the urgency with which they need to act. So we see that a lot where, in our world, when we walk into a bank or a CDFI and we're trying to say, hey, there's a better way than Word, Excel, and a network share. There's a lot of resistance to that initially. Because I think where people start to trip up is it's actually human beings working in these banks, and there's some control over the process that they can exert by these old antiquated solutions, and they think they're adding value when really you can outsource a lot of those lower level tasks to machines, let them win a few while you focus on a higher level and more value added task where you can start to build relationships, not necessarily be sitting there renaming loan files. Like that doesn't really add any value to anyone in the transaction. So I think there's the inertia. That's one thing. I think the other thing that we often run up against is, if you think about it, it's banks in not think I'd say CDFIs to a lesser degree. There's a lot of risk aversion in the sector. Because if you think about it, there isn't a lot of upside in it for banks that are lending to small businesses. In almost every instance where they're extending credit, the return is capped, and it's capped at the interest rate that you put on that loan. And all of that capital has to come back, or you've lost the bank's capital. So I think there's not a lot of appetite for risk taking in the bank sector. And obviously we see that in the historical data and a lot of where the certain credit thresholds are set today.
Well, and I would say not a lot of risk appetite in the bank sector, both because they don't want to lose the capital, and regulators tend to have a heavy emphasis on risk. So where do the regulators come into play here?
Yeah, it's interesting. We were just down with the Texas Bankers Association, and we were sitting in the CEO roundtable, and in some ways you have to develop a little bit of empathy for these folks and kind of what they have to deal with, because it's like, well, why aren't you guys getting into blockchain, and why aren't you getting into crypto, and why aren't you figuring out how to eat into Coinbase's margins and be a custodian for and they're still stuck back with OCC came in and talked about this, and FDIC came in and talked about that, and SBA came in and talked about this. So you think about all this regulatory environment that surrounds the banking sector. It's no wonder that there's not a lot of risk appetite out there. That being said, I think that there are trends and there are opportunities that banks have kind of watched to go by, and the fintech sector has really jumped onto and glommed onto, that we can push a lot of these best practices out into the bank world. And that's where the amplification comes back, is the stuff that is working, let's get that going. The fact that, it was still, up to about probably a year and a half ago, the call to action on the Wells Fargo website was to call your banker, come into the branch. There was no ability to actually digitally engage. And whether the banks understand that or not, consumers are making a value judgment about you and your brand by the way in which you present yourself digitally. And that, I think, is not going to change. That's never going away. Airbnb, Apple, True, all these services that are built with these elegant experiences in mind. Financial services, for some reason, some way, has lagged behind. Not all of them, but a majority of the market has lagged behind those types of experiences. And we don't really think that there's a good reason for that.
So Nick, the whole marketplace concept, particularly in an automated loan origination world, when we look at the formations of these new marketplaces, we've got a lot of new tools that we can use in respect to this. So you talked about APIs. In China, loan origination markets now, there's a lot of work being done on the blockchain. Where do you see the automation of this marketplace going over the next few years? And how well placed do you think the US is in respect to, say, the EU or Asia, where they seem to be a bit more aggressive on some of this stuff?
I think so when I think of marketplace, I think of shopping. I think you're shopping for a credit. You're trying to figure out, kind of what you qualify for, what's out there, what's available. There's a lot of marketplace platforms out there. We're really, obviously well affiliated with Connect to Capital. We have a lot of friends over at Fundera, now part of NerdWallet. So a lot of these solutions are in the market, and they're helping small business owners cut through the noise and get to a solution. I think there's going to be this balance and play of, who's shopping and not a customer versus somebody who is a customer, and we do have the data. I think those are two different things. So you kind of get into the banked and the unbanked. That being said, I think how the US is positioned, I think about open banking in the UK, and how the users own their data and are able to control it and take it wherever they want to go.
PSD2 and all of that.
Absolutely. California is starting on that path. And so that's a positive development, because then we can start to use data in ways in which we haven't been able to historically use that in the bank sector today. I think listening to some of these folks in the banks, even at the highest levels, the CEOs, et cetera, talk about trying to understand the data that they have still.
Well, it's only recently that we've actually had legal precedents in place in the US that have established that customers own their data, because the Big Four's position previously was that they owned the data. The customers had no right to that. But thankfully, we now have some legal precedents in support of that. So that's it's a very different legislative environment than the UK and the EU. So, sorry, Jason, you go.
Oh, I was going to say, let's get into this idea of is the data is one of the issues, but those who, reside outside of the banking system historically have had a very hard time breaking into it, data being one of those issues. How else are you helping solve that, Nick, and especially around those partnerships with CDFIs?
Yeah, CDFIs are actually the ticket to that solution in our mind.
Could you just explain what CDFIs are for if anyone's
CDFI,
listening that don't know?
Yeah, acronym short for Community Development Financial Institution. There's about over 1,000 of CDFIs kind of located all throughout the country. Some that are very large, some that are very small, even down to the neighborhood level, and then also up to the national level. So it's quite a wide range of organizations. The great part is that the capital that CDFIs have is a subsidy, and it's meant to help unbanked and underbanked small business owners, affordable housing, et cetera. Folks that are not bank ready still should have access to affordable credit. I think the challenge has been CDFIs haven't necessarily been able to compete in a digital world, getting their voice out, getting their reputations out, getting the message out that they're here to help. The way we look at it, it should go, if a bank can serve a customer, great. If a bank can't serve a customer, a CDFI should. And just for the fact that the small business owner can't find them is not a good enough reason. That's why we're saying there's a better way. And that's to say, okay, bank can't serve, one of our banks can't serve, one of our CDFIs can, let's make that connection systemically through the technology. Now, again, I think if we think about kind of where they do really well, and again, this is a virtuous circle. It doesn't just end once the business owner takes out a CDFI credit. The CDFI can then attach advisory services to that business, help them grow, and then when they're ready to go back to the bank, that's success for the CDFI. And then the small business owner is able to traverse up and down the credit cycle and credit products available from both banks and CDFIs as part of that solution.
Yeah, because unfortunately, if it isn't the virtuous cycle, what ends up happening is they end up with a payday lender, and that ends up being a non-virtuous cycle of being stuck treadmill. In the credit treadmill. Because unfortunately, the payday. Go ahead, Brett.
No, 99% of America's 28.7 million businesses are small businesses. And so as we've seen during the pandemic, they're the lifeblood of employment. And when these small businesses have to close, when they're unfunded or underfunded, then it's a massive risk from an employment perspective. But what we saw during the pandemic, if it wasn't for the PPP loans, the appetite for risk for lending to small businesses during the pandemic was basically zero. The same happened during the global financial crisis back in 2008. So how is it we change that culture that small businesses are seeing as risky? Because, you've got startups getting plenty of VC funding and stuff like that if they can navigate those paths. But the traditional funding mechanisms through banks just seem to be getting harder and harder to get access to, right?
Yeah, I think where the world is headed is a place where capital is largely ubiquitous. That it's going to be available everywhere. I got a letter from Comcast, or ready for a small business loan? Like, what do you? Why are you throwing credit out? You're a cable company, but they believe they have a proprietary data stream that they can use to extend credit in very much a similar way to Amazon and other places.
Well, just even seeing if you pay your your cable and your phone bill on time, right?
Absolutely. And so where we start to see the big four, they've largely become in some ways, money stores that are driven primarily by credit models. And what we're also on the hunt for, and we come across them infrequently, but we want to see more frequency, is providers that are working on scoring the unscorable, working on trying to figure out how models can work for people that don't have a credit history. What other means of data or streams are available to make a decision about someone without having to, intimately know their whole history? That, and then again, back to amplification. If we can get a hold of those partners, we can activate those partnerships in our technology and then push those products out to our customers. Much in the same way that when PPP came along, nobody knew how to do a PPP loan before the rules were written. But once we got a hold of the product, we were able to come to market on the first day with a product, and it went really well for everybody that was on our technology. So that's the good example of that network effect actually happening. Well, now we're saying, okay, if it worked for PPP, why won't it work for some of these other unique credit models that we can then amplify out through our network?
There was a startup in Africa, Brett, you might remember the name, it's escaping me now, that we had on, that they were doing their underwriting based on what apps and data that came off of your phone. And what they found was an interesting correlation with the presence of a gambling app. And it turns out if you had a gambling app, it went one of two ways. If you had a gambling app,
I remember this,
and you always kept your phone charged above a certain level, you were actually a very good credit risk, because it meant you understood kind of this risk return profile. And part of that is because the ability to charge your phone, was spotty at best, that you had a level of responsibility attached to it. And so presence of gambling app alone, bad. Presence of gambling app plus you keep your phone charged, good.
Yeah.
In those, I think
you're always ready to take a gamble if you're charged up, man.
Well, maybe that's what it's saying.
I don't know. The same with, we had Scott from a lending club on not long ago, and he was saying that, whether people paid their phone bill on time was a better predictor of default risk than a credit score, So for lending club to, just that one data point, it's extraordinary. So the behavioral element of this, you talked a little bit about that, but where, and you talked about trying to build trust in these models, it seems like after a crisis like this with the pandemic, that if people's credit scores have taken a massive hit because their business has failed during the pandemic, that's no longer a reasonable assessment of their ability to run a business or manage a credit line, because these were extraordinary circumstances. And so how do you now, convince banks that the credit score in this environment is bad data and that there's better data available?
Yeah, that's a good question. I think where we've spent most of our time is helping our customers, specifically the banks and CDFIs, transition over to a lot of the government guaranteed products, the SBA products specifically. So whereas their conventional lending was at a specific level above, pre-COVID, we've seen those levels increase pretty dramatically. And there's reasons for that are both, economic, but also the more flexibility that you have in the SBA products to go to different credit scores. We haven't necessarily seen the SBA loosen up much of their credit criteria. So SBA uses a scored model for loans below 350, and they haven't necessarily loosened up some of those thresholds. So there's still some screening that's getting done at the SBA level. So I think we don't really have the answer right now for how we're going to get banks over that hurdle and get folks back in. I think there's also, what we're hearing is there's also a demand issue on the part of the small business community for some of the credit products that we were seeing in market, sort of pre-pandemic, which were, I don't mean to bash, but like folks that are competing at the minutes, like, I can fund a loan in 2 minutes versus 3 minutes versus I don't know that that's a realistic way to differentiate.
Although in China, that stuff has become a benchmark. where
Yeah.
Players like Lufax, Alipay, Tencent, WeChat Pay, with their loan and credit provisionings, they have put real pressure on the banks because they can essentially do instantaneous loans, but that's because of their data.
Absolutely.
It's infrastructure as well, but it's primarily the fact that they've got much better data models. So here's the question for you. Do you see your organization as a data platform for these alternative mechanisms? Because as you said before, the banks don't even have good access to their own data, let alone these additional data points that reflect behaviors and risk in a different way.
Sure. Short answer is not today. I think in the next probably 12 to 24 months, absolutely. I think we have a ton of really good information on origination. We don't have that sort of trailing, how did this business actually perform, without going to our customers and asking for it. Because our platform today kind of ends at final loan disbursement. It doesn't go through the life of the loan all the way out to, kind of call it 2, 3, 5, 10 years. But we're building that right now with the idea that we can develop recursive self-improvement, where through machine learning and other items, the models that are extending credit at the beginning can be informed by the performance of the loans that are going through the tail and feeding back into the front of that mechanism. So we are heading in that direction. We're just not there yet.
Well, in that recursive approach, I think is one of the most necessary things is, we round this out to look at how historically these data models and specifically even something like the SBA have actually propagated a lot of systemic bias because
absolutely
they don't evolve. And I'm curious what you've learned in that approach as you actually have these models become evolutionary. What have you seen that open up?
Yeah, so when a good example, SBA, when they first launched their scoring products for the loans under 350, they set their threshold, which they built their models off of FICO's small business scoring service. So FICO Liquid Credit. There was a specialized model built for SBA that set that threshold at 140, which they were, and so at so what that means essentially is that the SBA was buying kind of call it a 12% default rate. They expected kind of about 12 to 14% of those loans that were extended under that program to default. That's what that model would predict. So that was set at 140. Now, when they launched the Community Advantage program, which was specifically designed for CDFIs and others, they set that threshold at 120, which was around a 20% default rate. So they were, and if you think about what the SBA actually is a loan wholesaler. I mean, that's exactly what they are. And so they were buying that credit risk through those models and then using, the banks and others that access the SBA program to extend that debt that way. So now I think the challenge with liquid credit and some of these other models is that the predictability of those models and the data streams that go into them, that the quality of that is what makes the model great. And so we're starting to look at other providers, DMIST, PayNet, et cetera, that have alternative streams and combining it with FICO Liquid Credit. So you start to get a model of models. Now, the big knock on all the fintech companies and the credit scoring that was going on pre-pandemic was, once these models hit a recession or a downturn, we're going to really see who's got the best credit models.
So on that, we've only got a few minutes left, Nick, but I want you to sort of put your futurist hat on here and think out maybe 5-10 years. What we've got right now is a very interesting situation. The deal with Affirm and Amazon that was announced last week. That spells, in my view, the end of the credit card business, because as buy now, pay later and more contextualization of credit comes into place, you just use your credit card less and less. It's now credit is just built into the journey as an option for you. And so if we extend that into the world that you live in, do you think that fintechs like Affirm and other players could come in and take some market share of traditional lenders over the next 5 to 10 years?
Yeah, absolutely. I think that the writing is on the wall there. And we talked a little bit about it in the middle of the conversation, but the idea of the ubiquity of money. And so what we think about is if money is available everywhere and from a lot of different sources, and some of those sources have more elegantly designed experiences that are more delightful for customers and easier to use than some of the harder ones, and the cost of capital is the same. People really got to step back and say, how are we going to differentiate against that solution? And so I think if we look at, where is the world going, we have to start designing in the bank sector and in the financing sector. We have to start designing experiences that mirror or match some of the other Silicon Valley based experiences that are out there in order to compete, if we want to compete. I think that's another question I think that banks have is, are they willing to cede some of these markets to others and not even play? And I don't think that that's the right answer. I think if we cede the small business community to venture capital and hedge funds and private equity, I think we all lose a little bit in that world. Most of those solutions are built to extract value from business owners and not necessarily grow with them, but grow from them.
Right.
And I don't think that we're really interested in that.
Okay, so Nick, where can people find out more information about Spark and what you guys are doing?
Yeah, I encourage everybody to head out to lendwithspark.com. We've just recently gone through a new rebranding. We're putting a lot more content out there. And again, we're really all about helping business owners access traditional credit through a lot of our different partners.
Fantastic. Well, thanks for joining us on Breaking Banks this week, and all the best with your continued endeavors.
Yeah, thank you for having me. Really appreciate it.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.